Retirement Heist, her landmark book, won the Helen Bernstein Book Award for Excellence in Journalism. So I'd like to introduce her, bring her up, and give her a warm welcome. Thank you very much.
We're here to find out what killed the Delta pilot's plan. Now, Delta says it was a perfect storm. It was interest rates going down, which raises the liability. It was the market crash. It was 9/11. It was fuel costs. We have to look at the available data to see exactly what happened. You have to look in the black box for as much information as you can get. The 90s were a good time for pensions. The plans had become very overfunded, in some cases with billions of dollars, at most of the large companies. The plans were a very appealing piggy bank, and companies were able to tap them for billions of dollars. Behind the scenes, Delta was meeting with its consultants and lawyers, and the consulting firms became more aggressive in the 90s, far more aggressive. But the consulting firms, the Towers Perrin, the Watson Wyatts, the Aons, Mercers, all developed a very strong business side, and their goal was to help employers get out of their retiree benefit obligations, including obviously the pensions and the retiree medical, or anything that creates a liability. This is at a time when the companies were also discovering how important it was to make their earnings look good in order to boost the executive compensation. One of the biggest ways that companies siphoned money, and the consultants use that word, is by restructuring or mergers, spin-offs, acquisitions, in which they're able to monetize the assets. The perfect storm was companies discovering that they could use their pension plans to manage earnings. By raising or lowering the discount rate, companies would naturally reduce their interest rates to increase their liabilities during contract negotiations. If you go through the history and you suddenly find that there's a jump in liability, it is usually caused by, obviously, the discount rate, and it can also be caused by the change in expected return on the assets. So the year before a collective bargaining or a merger or a bankruptcy, you adjust the interest rate and other assumptions, and you get that liability as high as possible. And I did see that in Delta's case. This occurred at the same time that executive compensation was becoming extremely important to companies. Again, the same consulting firms were showing them, the employers, how they could increase executive compensation using earnings targets, stock awards. You can imagine how the timing of your earnings rise and fall would be affected by the interests of the executives. It could make a difference of millions of dollars. And this was creating an incredible liability at companies because executives were not only getting higher pay currently, but they could defer much of it or have it in a SERP, a Supplemental Executive Retirement Plan. So you have billions owed to executives. And this is hidden because they don't have to break it out. In the pension footnotes, it's aggregated with your pensions. So the Delta management liabilities are impossible to see. They're part of those totals. So when companies say, look at our growing pension obligations, well, that includes a lot of executives in there. If your plan becomes less well-funded because you've pulled money out, then what you need to do is cut benefits. This explains why so many companies in the 90s were frantically cutting benefits, even when they had massive surpluses. The reason why, they wouldn't tell me, and the reason why people didn't know, even all those engineers at IBM, was because companies deliberately hid this maneuver. They told people their pensions were worth the same or better, and they weren't. They were hiding the cuts. Offering lump sums was one of the primary ways to cut benefits without people knowing, because you would calculate it differently when you paid it out. Nobody hires an actuary and says, is my lump sum calculated appropriately? If the employee cuts their own plan by unknowingly taking a lump sum that's worth less, no anti-cutback rule has been violated. I do doubt that the people who were agreeing to those changes understood the impact. So you have those cuts taking place. We hit the bad times, and you can see how the liability grew here. And they, of course, pointed to 9/11. They pointed to the market, the dot-com bubble bursting, expensive pilots, and so forth. Delta, at the bad time, set up secure trusts for top management, and they funded them with, at this point, $33 million. These trusts were not only protected from bankruptcy, because they were not, obviously they're not part of the regular pension plan. They're a trust fund with provisions that spring the assets if there's a bankruptcy. Because executive pensions are protected. They don't lose them, unlike you. If you look at the red line for obligations, you'll see that they ran up very steeply at the time right before the run-up to the plan termination in 2005. You would think that as the company's pension became less healthy, they would contribute more. If you look at the bottom line here, the zero, you think it sounds high if they say 300 million. People are thinking 300 million, that's big. You have to put it in the context of billions. And if you do, that's where it would run. So we don't have a good contribution history ever at the airlines, Northwest or Delta. Now the problem for the pilots is you can't tell at the time how much money the company is contributing to your plan. To give you an example, the U.S. Air pilots were unaware that their plan was in trouble. They thought it was great up to a month before the company filed for permission to terminate the plan. And that's because they could not or did not get the information about it. They couldn't tell if management was starving the plan, which it subsequently acknowledged that it did. It had not been contributing to the pilot's plan, but was contributing to the other plans. When they went into bankruptcy court, U.S. Airways had hired Towers Perrin and other experts to testify at how huge the liability was. Well, who was on the management side in these arrangements? Creditors want to see the plan killed. There's no one standing up for the pilots except, the pilots and PBGC. When they went into court, their actuary, the pilots, had so little time to prepare because this bankruptcy was fast-tracked, and it was a month from filing to when it went into court. Their actuary requested the needed documents, the 5500s, for the pilot's plan, and a few days before the hearing, the company sent him a bunch of the plans, except the pilot's. So he requested it again. And the day before the hearing, he did get the pilot's plan for the wrong year. So he went into court to argue their case without the information that he needed. And what's really sad is that the court said, well, those pilots based their calculation rules on rough estimates, while the U.S. Airways actuary based his on the actual computer model used for administrating the plan. And when I asked U.S. Air about this, their spokesman said it was quite clear that we had made reasonable assumptions and the lack of credibility of the plaintiff's witness was obvious. I did look at comments that Mr. Bastian made in the hearing, and again he was arguing, using the data he'd been supplied with, that the plan was, totally, on its deathbed. It had to be killed or the company would liquidate. He said, if that happens, think of the jobs, it'll hurt the economy, all those poor passengers will be stranded. As you know, the plan was killed. Subsequently, there was a critical change in the funding rules, which Delta had been arguing for. Had they waited a few months, they would have been able to take advantage of the changes under the PPA, a Pension Protection Act, which would have enabled them to use a more favorable discount rate and to stretch payments out longer. But they pushed through the termination before that happened. They could have done other things apart from killing the plan. They could have used more reasonable assumptions. They could have delayed the termination. They absolutely could have, but they did not. So with the extension of the funding changes, and if they had waited, they wouldn't have this kind of liability for the pilots or for the other plans, because they could have slowly funded and waited for interest rates to change and maybe stopped that executive liability from growing so high, and they would have been in shape to preserve the plan. You look at the fact that the obligation is at like $20 billion now, and that includes getting rid of Delta pilots and freezing the Northwest plan. What's going on? Again, you need to hire actuaries to question every single claim that the company makes about their liabilities. You need to look at how much money they're putting in every year. I would really look closely at the plan, the way it's run. I would ask very strong questions of the company about their investing, the investment returns, the assumptions about them, and many of the other things I'm talking about. You have to look at where they're allocating their cash. Where are they allocating cash flow? And why aren't they contributing more to the pensions? Because the pensions are not a gratuity. They're not something that nice that you had them and too bad that they're gone. This is compensation that was negotiated, is in a contract. The country is built on contracts. If we just decided we don't want to have contracts because we don't feel like it, obviously, things wouldn't be able to run. So going forward, with the claims that the company makes about why they can't set up some kind of replacement, you would need to hire experts in the law and in the plan structure and actuaries. And if you're not comfortable with the notion that a DB plan will always be there, thinking about other types of arrangements that might help make up for what you have lost. The company says, it's too complicated to figure that out. There's something called a computer, and computer programs. If they can do all of this in mergers and change all the interest rates assumptions and time it so executives get more and the plan gets more costly before you go into contract negotiations, if they can do all that, with all the pilots, with all their different kind of pay structures and ages and potential retirement dates, I think they could come up with a plan that would be secure and that they could afford, that could try and make this up. Because your 401k is not going to do that. It's not going to do that. If you're 25, maybe it'll do that. If your salary's good and you put some money aside and you don't have college tuition and mortgage payments and medical bills. But it's possible in some ways. And the question for you is to talk to plan designers about what could be done to set aside tax-qualified money that you aren't paying taxes on currently, like an IRA, and that is secure because it's in a separate account for you. If it's a separate account, the company can't take it. You've got to hire experts to look at it. You've got to get your union. You've got to get ALPA, if they will. If they won't, get somebody else. Get another union to do it, because you can't do this on your own, and you can't rely on ALPA, from what I've seen. But also, I see in the bankruptcy filings, ALPA was like, sure, kill the plan. The pilots sort of agreed because they didn't know what was going on. ALPA should have known. They should have asked questions all along from any kind of compensation arrangement that included deferrals. And that includes things like retiree health, because that's an obligation also. It's something you're earning by working that will be paid to you in the future. Well, if they can do that for executive compensation to offset the cost, I don't know, I'm getting fanciful here, but why not you? Anything you see that's done to help finance and protect executive pensions, ask yourself, why not you? So if you really are serious about getting your retirement benefits restored, you do have to ask these questions. You have to maybe not rely on ALPA for some of the answers. You need your own people.
Remember, we filed on September 16th. The legislation that you mentioned, Ellen, the pension preservation, that passed about 2 weeks later. At the time, we knew the legislation was going to pass, which basically said, in our case, if your pension plan is underfunded by under 80%, you don't have to pay lump sums. And that was across the board, whether it was GE, Procter & Gamble, Delta, it didn't matter. So my argument at the time was, number one, you're filing Chapter 11, not 7. You're not going to liquidate. You're trying to restructure. They also had information from an actuary that the fund was not really in trouble, even though it was funded at about 54%. Okay?
I believe I know what you're talking about. It was throughout the lump sum issue. They closed the door in October 2005, I believe. Closed it because they did not meet the liquidity threshold rules that said if you get underfunded by a certain amount,
Right.
you don't have to pay out lump sums. So they didn't meet the threshold on purpose, I believe.
Right.
And when, I believe it was July, it came around, they actually passed the threshold, and that's when Mr. Bastian, I think, went in and argued that that shouldn't be, something that was going to affect the lump sum arrangement. They also knew that they would pass the threshold in October for sure. So this was a good reason for moving things along. And yes, they knew about the timing of the legislation going into effect because they had been lobbying. The airlines vigorously lobbied for that, and they have been among the main companies that have profited from that.
My point is ALPA knew. ALPA had that information and didn't just decided to, they got convinced that moving to a defined contribution plan was going to be in everybody's best interest, but it was misguided. And all I can say is they knew.
How would you rate ALPA's competence in protecting our benefits?
Well, the answer is sitting in this room. I can't give them a grade on competence, but I can give them a grade on the results.
We're honored to have Dr. William Lazonick. He is a professor of economics at the University of Massachusetts. He wrote Profits Without Prosperity, Stock Buybacks Manipulate the Market and Leave Most Americans Worse Off. That article in the Harvard Business Review won the McKinsey Award for outstanding article in the HBR. He has a PhD at Harvard, so I'd like to give him a great warm welcome for being here, and thank you.
And it's really a pleasure to be here to talk to you because I think this is something that people need to know about. Many people, academics who study the stock market, don't say anything about stock buybacks. Okay, and they're not good, at least for you. They're good for some people. We'll find out who. Companies grow big because at some point in their history, they were really doing stuff that was delivering value. So what these companies do or what they don't do, how they invest their resources, how they employ people, how they pay people, is going to have a big, big impact, I'd say the major impact on the performance of the economy as a whole. And that's why when I had this article published in Harvard Business Review, I called it Profits Without Prosperity. So, where's the prosperity? And then the subtitle, Stock Buybacks Manipulate the Market and Leave Most Americans Worse Off. It started with this graph on the relationship between growth and productivity, growth and wages in the U.S. economy. It's a very aggregate number. From 1946 to 2012, for over a long period of time. And you can see the break that occurs in the mid to late 1970s, where you start getting a wedge between productivity and wages. Up to that point, productivity attracts wages, and the wedge gets bigger. Actually, productivity has also slowed in the last few years, but wages are stagnating for most people. Then, of course, the question is, well, why? I'll give you two words, stock buybacks. I think they are the most important reason why you have this gap and why the gap is growing. Companies now are being run to keep their stock prices up. And a really great way of trying to keep your stock price up, it doesn't actually work very well, but trying to keep your stock price up are stock buybacks. Okay. And very much related to stock buybacks are something that people have also noticed, a explosion in executive pay. Executive pay, top executive pay seems to be going up and up, while everybody else is losing. And the losses of everybody else are not just in wages, they're employment security, they're in retirement benefits, health benefits, etc. In the 1990s, they went from retain and reinvest to downsize and distribute. So you're retaining people, retaining money, reinvesting in your productive capabilities, and growing. But that is essential for the success of the economy as a whole. And what the major firms started doing in the 1980s, and increasingly, is just downsize and distribute. More and more, the downsizing just became a matter of, okay, we can lay people off and we can pump our stock price up. And we pump our stock price up by delivering more cash, distributing more cash to shareholders. That cash is distributed in two forms, dividends and stock buybacks. Here is a picture of that distribution in terms of stock buybacks. Now this is net equity companies issuing stock minus stock that's taken off the market through stock buybacks and some extent merger and acquisition activity. Actually, in 1984, that blue line is non-financial industrial corporations. It starts becoming negative. It's volatile, but it really becomes negative between 2003 2007. Then in the financial crisis, they cut back quite dramatically, but then they start up again. Okay, now this is gross buybacks and dividends by a set of companies. In the early 1980s, they weren't doing buybacks. This started to change in 1982, and I'll show you why, and it became more significant in the last half of the 80s. It surpassed dividends in 1997. It went down in 2001, 2002, and then up. Meanwhile, dividends are rising. That's the green line. So it's not instead of dividends, it's in many companies, you can see this at Delta, it's on top of dividends. Dividends go up and buybacks go up. That blue line is the S&P 500 index. You can see particularly over the last decade or so, when the stock market goes up, that's when companies are doing the buyback. So they're buying back their own stock when the stock is expensive. These are the same data just going back 10 years, and 53% of their net income over that period altogether went to buybacks, 36% to net income, that's 89%. The other 11%, a lot of it's held overseas. Okay, here are data from a company called FactSet, which has a quarterly buyback report. You can see that green line, you can see about 380 of the 500 companies are doing buybacks. Most of them are doing buybacks. This is not unusual. It's been typical in the last couple of years to be at about 130 billion, 140 billion for the S&P 500 per quarter. So it's getting close to 500 billion, 600 billion a year. It's just going to the stock market in the form of buybacks. Here's Delta's history of showing net income on the right-hand axis and buybacks and dividends on the left-hand axis. And you can see 3 waves of buybacks, that silver line. I didn't adjust it for inflation, but you can see that the buyback that it's been doing recently are far outstripping what it did before. What we can say is that when it did buybacks in the past, that was actually followed by recessionary conditions where they might have wished they had the money. Here is Delta's stock price, month by month buyback that they've done since July of 2013. So these numbers add up to 5.46 billion. You can see that the stock price was going up anyway. Buybacks didn't push the stock price up to the levels that you see it there. That had to do more with conditions in the industry, etc., consolidation, a number of other things. But along the way, in doing these buybacks on a month-to-month basis, the objective is to get that stock price to move up a little higher. Okay, now, you do a lot of buybacks, and the stock price can still come down. So Greg did a calculation, I think he said, if you look at those stock prices from December, it's about a 13 billion loss in market capitalization. So you've spent 5.46 billion, 5.5 billion trying to pump up your stock price. It's going to come down anyway. Stock price, using buybacks to get your stock price up is not something that's beneficial to shareholders if you take that shareholders' part seriously. It's beneficial to share sellers. The only way you make money out of stock buybacks is by selling your shares at the right time. Okay. And who can do that? Well, we'll find out. You get a lot of arguments that are made, both by academics and by executives, about why they do buybacks. So one argument that's often made is that, oh, our stock is undervalued. We have to buy our stock because we have confidence in it. But we can see from the numbers that, in fact, most companies are buying their stock when the prices are high. The other problem with that argument, if you make that argument, and it's taken seriously by the market, when you stop doing the buybacks, people are going to say, oh, that's a signal your stock is overvalued, and they're going to come down. Now, one which seems a little more plausible at first is particularly with companies that give out a lot of stock options like a Cisco or an Intel, some of the high-tech companies. They're doing this to offset dilution of shareholding of earnings per share. As a result, when employees exercise those stock options, you're going to have a dilution of shareholding. Okay, but it's a phony argument. You give people stock or the option to buy stock. The idea is, 3 or 4 years down the line, the stock price is going to be higher if you stay with the company. They should be working harder and smarter to try to get that company to perform well, and the stock price should go up because the company is actually more productive and more profitable. And at that point, if they do that, they can go to the market, and the market will pay them for that increase in the stock price. The company shouldn't be coming in there and guaranteeing that or trying to give them that right away. It makes a mockery out of the notion that these are incentives. And in fact, when companies do that, particularly when they're doing it, and the top executives are doing it, as we'll see, getting paid most in stock, they're not really incentives. They're just a way of padding their pockets. Okay, the third argument, this is actually made more by academics because even most CEOs won't make this argument that, our company is mature, we have to just give away the money. There's nothing we can do with the money, or they won't make it too explicitly. But any CEO who makes this argument that, we're mature, give our money back to shareholders, is not doing their job. There's some other problems with this argument. They call it capital return programs. Return to who? Okay, in the case of Delta, there was a lot of debtors, for example, who got stock. Well, they should be quite happy with what's happened to the stock price. You don't have to give them any further incentive to sell by boosting the stock price with stock buybacks. And the only way you're going to make money is if you sell it at the right time, when it's given the boost to the stock price. Actually, very few people, other than some insiders, know when they're actually doing buybacks. Now, for the U.S. economy as a whole, this has become a major source of pay at the top. So these are data from economist Thomas Piketty, and showing the sources of the incomes of the top 1%. And you can see by the peak, let's say in 2007, that you're over 12% of all the income in the United States, this is including capital gains, is going to the 1/10 of 1% at the top. So growing income inequality. And a big chunk of that is what's called salaries. And you can see, for example, that peak in 2000, that peak is going up because of a stock-based pay. It's a big part of the whole portion, but it's going up even more when the stock market is high. Now here are data for highest 500 paid executives. This is what the top 500 each year, 2006, 25.4 million, 2014, 34.3 million. It goes up and down pretty much with the stock market, and most of it is stock-based pay. Those two blocks at the bottom, the orange and purple, that's stock-based pay, and that's anywhere from 66 to 84% of the total over this period of time. Now here again is the stock buybacks again. You can see that this wave that has occurred more recently, and that's showing up in executive pay. So here's Anderson's pay, and you can see again that most of it is actually stock awards. You get stock price up, your pay will go up, and you can see the results here. He got to 20 million before he stepped down as CEO. Bastian, he managed to get 2015, 33.7 million. So maybe Anderson might be a little envious of this, but he got something timed right there. He was a CFO. Closer to the numbers, I guess. In all of these graphics, it's stock-based pay that's driving up their total pay. Okay, and stock buybacks are helping. Now, I'll explain how that works. So first of all, you got to differentiate between a program and a purchase. Okay, so companies announce a program. Boards do this in order to help protect themselves against charges of insider trading. And they'll say they're going to do it over a certain period of time. Maybe no termination date. In Delta's case, the current buyback plan was started in May 2015 to be completed no later than December 31st, 2017. That just authorized executives, the top executives, call them CEO, CFO, to say, okay, we want to do buybacks on any given day, at any point in time. They don't have to go to the board. They don't have to tell anybody. As long as it's within the authorization, they can do it. Okay. So that's when they do the repurchases, and that's what's giving a bump to the stock price. By the laws of supply and demand, you throw $500 million out there on a given day, it's going to help bump the stock price up. You start watching the momentum of your stock. You try to time it so your stock price is moving up. You give it a further bump. The hedge fund guys see this. They start speculating more in the stock. People start talking it up, etc. That's how the system works. And you get the bump, and someone's going to sell and make money. But if you or I hold the stock, we have no idea when they're doing the stock buybacks. If we're not in the business, including pension funds, of just churning your portfolio to time the buys and sells short term, you're not going to make money. So the people that make money are the people who can time the buying and selling of stock, and that's the business of Wall Street, and it's become the business of top executives. Okay. Now, why can they do this? Well, way back in 1982, Securities and Exchange Commission, which is supposed to regulate the stock market, had this adopted this rule called 10b-18. And it said that a company, top executives, if they wanted to do buybacks, they could do up to 25% of the average daily trading volume for the previous 4 weeks on any one day and have a safe harbor against being charged with manipulating the stock market. Now, the safe harbor is important because it means that if you go over the 25% limit, you're not necessarily manipulating the stock market, but you may be. Now, Delta Safe Harbor, they could do up to 111 million a day, and they can do them day after day after day. So if you want to influence your stock price, you can do it through stock buybacks, and that's what you're trying to do. You're trying to manipulate your stock price. Now, the SEC, at the same time as it promulgated this rule 10b-18, said companies don't have to disclose the actual dates on which they're doing buybacks. So we don't actually know what dates they're doing buybacks, when they're given this bump. And the SEC has never, in fact, investigated a company for insider trading around the timing of buybacks. Or if they have, it's been an extremely minor case. Okay, it's not what the SEC does, isn't even equipped to do. This is the one newspaper article, it was in Wall Street Journal, and it says, SEC eases way for repurchase of firm stocks. And the subtitle is important. Agency assures it won't file charges of manipulation if certain rules are met. John Shad, he became the chairman of the SEC, and he turned the SEC from being regulators of the stock market to promoters of the stock market. In April of 2015, for the first time ever, a U.S. member of Congress questioned the SEC about stock buybacks. This is a rule that has actually never been vetted by Congress. It was really passed under the radar by the SEC. It's not even hardly in the histories of the SEC of important rules that it's passed, but it's actually destroying the U.S. economy. The SEC Chair Mary Jo White responded, said SEC admits it's not monitoring stock buybacks to prevent market manipulation. Senator Baldwin wrote a second letter that said, your previous response did not sufficiently explain what the SEC is doing to respond to the buyback phenomenon. I request that you respond to the following questions. What steps are you taking to investigate the risk that share buybacks could be manipulating stock prices? Have you opened any investigations into specific questionable buyback practices? Given that you've explained that the Commission lacks the necessary data to perform analysis on buybacks, are you working to improve your data collection efforts? The overarching reason I am interested in buybacks is that I'm concerned that they may come at the expense of investments in innovation, research, and workers that are necessary for stable and equitable growth, as some academic studies have suggested. If you look at the website of the SEC, the Investor's Advocate, the SEC protects investors, they mean you and me if we buy stock or our pension funds, maintains market integrity, and facilitates capital formation. I have no hesitancy in saying those are all lies. It's not pursuing that mission at all. As long as it has 10b-18 on the books, it certainly is not. Some people will say, well, if I hold shares in a company, Delta, shouldn't I like buybacks or boosting up the stock price? Not unless you, again, are in the business of buying and selling shares. Institutional investors should want companies to pay out dividends if they can afford it, so you get an income, and reinvest the money productively. The damages that buybacks do, well, they undermine the way in which you keep a company productive, keep a company healthy. Investment in plant and equipment. So we've seen what's happened to Delta just in the last few days. And I've been told by people here that the computer systems could have used an update. And certainly spending even $1 billion on updating your computer system, that obviously has priority over buybacks. The revenues are being lost. You have damage to the company. Research and development, you want to spend more in the future if you're a company that does R&D. Not all companies do. Like airline companies don't typically do R&D. The critical issue is something that actually isn't measured, at least explicitly, is the training and retaining of people, your human assets. You don't want to pay people if they're not productive, but if people are productive and you want to incentivize to be productive, you share the gains with them. And one of the ways in which you share gains, with what this seminar is about, is through retirement pay. It's not the only way, but it's certainly, the money is there at Delta if they can do $5.5 billion in buybacks since 2013 to put priority on other things. And one of those priorities, if you raise your voices loud enough, can be retirement pay. The ideology around this has changed quite dramatically from the time when we saw companies did very little in the way of buybacks to the present. You have one in 1981 where it said we need to strike a balance among stakeholders. That had changed entirely by 1997. It said in the Business Roundtable's view, the paramount duty of management and boards of directors is to the corporation shareholders. The interests of other stakeholders are relevant only as a derivative of the duty to stockholders. The notion that the board must somehow balance the interests of stockholders against the interests of other stakeholders fundamentally misconstrues the role of directors. Well, a lot of people, including myself, have argued against this. In fact, that if board of directors are doing that, they're misconstruing their own role in being responsible for a company that has a lot of people who create value for it, and not out of just a notion of fairness, not out of just out of notion of what's right, what's moral, what's ethical. From a point of view of that business remaining productive and sustainable over time, you have to share the gains with the people who you want to be productive and make it sustainable over the time, the people who create value. Now, out there trying to get even more money out of these companies are the hedge fund guys. They're in all kinds of activities. But an activity that's become a real favorite of them is just going after companies, saying, doing lots of buybacks, get the stock price up, and then we'll sell the shares at a profit. These guys, what they make, at least the ones at the top compared to the CEOs, must make the CEOs envious. So I just have some figures here of the hundreds of millions that these hedge fund guys make. One of them, the airline industry knows very well, Carl Icahn. He's the biggest predator of them all. He makes his money by taking money out of companies. And he's perfected the art of value extraction. Important point is that buybacks undermine innovation in a number of ways. First of all, if the people at the top are thinking about that's how you should allocate your money, you're in trouble. So think about your pensions, think about the computer infrastructure or whatever. You can think of probably 100 different things where they should be spending money at companies, and where the CEO at least should be aware of the need to spend these things. And so what are they doing talking to these guys about buybacks, and why even having the discussion? And it certainly undermines what I call organizational integration, the learning process that keep people in companies, what I call collective and cumulative learning, that is the essence of productivity growth. And it certainly undermines another condition for productivity growth, which is that you can commit finance. You don't have to pull out. You have to sustain the finance. It's retained earnings that do that. Buybacks undermine all that. Joe Biden went in there and he started talking about buybacks and all these distribution to shareholders as undermining the middle class. They had done a study out of his office about what was happening to skilled workers in the United States, good middle class jobs, And they found that companies weren't training people. Now, companies are saying, oh, we can't hire workers because they don't have the right skills. Well, when companies want the right skills, they get the right skills because they train people in those skills. They don't just go looking for them on the market. And they found the companies weren't doing that. And then he read the Harvard Business Review article, mine, about buybacks on top of dividends. He said, well, that's obviously the answer, that companies aren't using their money in the right way. Now, in your case, what you can do, demand that restore lost pensions instead of buybacks. So one of the reasons Rich and Carl contacted me and we talked in Cambridge, we met a few weeks ago. Why I was interested in doing this is, as I told them, this hasn't been done. I don't know of any case where a union has confronted management and said, why are you doing buybacks instead of doing this, this, and this? There's lots of reasons why you wouldn't want them to do buybacks. And this is certainly a valid one. Get it together and confront them over this. But I think you can take the critique beyond that. I think there is a real need for a movement to get rid of buybacks, and you can go after this Rule 10b-18. Actually, all you need to do is go after Congress and say, why is that safe harbor provision on there? And you start raising the question of, is this manipulating the stock market or not? It's actually on the books of the SEC that this could be market manipulation. And before 1982, they would have called it market manipulation. This would have definitely been something a company wouldn't do, this anything near the scale they're doing them now. But it's not market manipulation because some people at the SEC passed this rule in 1982, actually without even having any comment on it. There's no comment that exists even from the shareholder community that said it's not, that we won't charge you with manipulation. Well, change that. Go in and say that, and there are some, fortunately, I think some political voices out there. There needs to be a regulation of executive pay. Stock-based pay does not work because the stock market does not just reward innovation or productivity. The stock market also rewards speculation and manipulation. Okay? And it's speculation and manipulation that are actually dominant out there now. And that's about taking money out, not about putting money in. You never can get rid of speculation completely because it's always speculative what's going to happen to the stock price. The stock market's always a gamble. And when I was first studying economics in the 1960s, I was told you don't put your money in the stock market unless you're prepared to lose it. Well, now obviously our pensions are in there. Okay, if our pensions are in the stock market, we don't want companies doing stock buybacks. Pay dividends and pay reasonable dividends if you can, but we want them reinvesting in value creation. And to do that, you have to change the way executives are paid, and actually you have to change the way they're trained. You might need to get rid of the whole lot of them. You have to go back to the business schools, change those. It's a big task. But if you don't do anything, it's going to go on. It's going to get worse. Okay? And I would say that not just in an emergency situation, but as a matter of course, and how you do this, I'm not quite sure in terms of finding the representatives, but you need to have the real stakeholders in there trying to understand what companies are doing with access to the information. Obviously, companies can't make all their information public, but you have to have some people who have a stake in the returns to taxpayers, the returns to workers who are sitting on these boards. Delta will see what they continue to do in the future. If they get persistent enough in doing this, they're not going to buy back all the shares, but they're going to shrink the outstanding base. And then the question is, could be using the money in other ways. Those other ways are going to be the kind of investments that are going to generate earnings in the future. At some point, I would predict, if they keep doing that persistently, their earnings are inevitably going to fall. And they might not just fall because of a computer crash. They might fall because they can't deliver the service, and there's other competitors who can. Obviously, you know this industry well, much better than I do, but you know, it's not an industry where you don't have capital expenditures to make. You know, it's one where you need that money. So it's even more so a waste of money. It's an industry where there's plenty of things in which you need to invest in all the time. You look at what's being taught in business schools, they'll say, it's your necessary capital expenditures and plant and equipment. So it's a foolish view of the business enterprise. And I can't even start to say the idiocy that comes out of the economics profession and out of business schools, not out of all people in business schools, but out of the finance part of business schools about how you run a company. And it's partly because they're really all talking, even when they don't mean to, about taking money out of the company rather than putting money into the company. And so dividends in a well-run company should be something that you pay when you can afford to pay dividends and remain competitive in the future. And remaining competitive in the future doesn't mean just producing the products you're producing today. It means investing in new products that can be competitive in the future, because we have a world of competition out there, and that's how you remain competitive. And dividends themselves should be what you pay when they're left over, never mind buybacks. But now these have become kind of a right. These are the first thing you pay, and you find the so-called free cash flow in order to pay them. Okay, thank you.